Hello, everyone. Dave Payerchin with the Cream. You'll have to forgive me today. I'm slightly under the weather. I got a little raspiness going on here today, but I'm coming to you with a raising capital and deal structure little fundamentals course. I got my main man, RJ, with me as well. RJ, are you there?
Happy to be here, brother.
Yeah, man. So RJ happens to be, he's out of the house. He's finally, hopefully getting some sleep. He recently had a little newborn baby. So we're happy we can get out and actually do stuff like this. It's been pretty busy, pretty hectic. Besides all the real estate stuff that we have going on, the family stuff has been really keeping us busy. But all is well. I think you're going to get a lot of value out of what we talk about here today. Make sure you visit us online, risewiththecream.com. And here we go. So I'm just going to pretty much go over like a current state of the market post-COVID. Haven't really done something like this since pre-COVID. So kind of current state of the market. Talk about why do we need other people's money as real estate investors, but then also a different spin on this is why do the private lenders need us? Okay. You're going to have a lot of ammo after, attending this and watching this that you can use for attracting your own private lenders, as well as it's just going to make you overall smarter when it comes to raising private capital and real estate. And RJ and I have done a lot of this stuff, so we're happy to answer any questions that you do have. And we're going to get into some simple deal structures here as well. We're going to cover all this stuff here. You're going to know exactly what all these things are. More on this here coming up here in just a bit. But current state of the market, what's going on right now? So post-COVID, I come to you today. It's late October 2020. And, with the US CARES Act and the whole COVID situation, Federal Reserve is printing money like it's going out of style. And this, you're going to learn kind of what this means for real estate, but also what this means for people's money. And whenever the Fed is printing money like they printed $2 trillion. Just take a look at this little slide I got here. In 2008, the financial crisis, you see the Fed increased their balance sheet. See the first arrow there. This is what's going on now. I mean, they are printing massive money, guys, and there's probably more stimulus coming. They're probably going to double down. So there is definitely some stuff that we can talk about and you can kind of use as your own ammo here. And it really is easier to raise money than ever before. And when you're backed with the facts that are happening right now, which you're going to learn from this stuff, I think you're going to be able to get out there and raise a ton of money. So here's really what the 2 trillion that's already been printed has gone to. About 560 billion to individuals, public health, 153 billion, state and local governments got 339 billion, small businesses, 377, big corporations right behind the individuals, ironically. They got $500 billion, guys, and there's more coming. It's just absolutely pretty crazy. I just thought this was an interesting little graphic here that I found. And whenever money is getting printed, that creates something called inflation. And what I've seen from talking to a lot of you guys and just having conversations is inflation is a really kind of scary financial word. It seems like this complex kind of thing. And it is, a lot of this stuff is complex, but it doesn't need to be. And it's always our goal to keep things as simple as humanly possible. And here's this graphic. And, I'm sure RJ, you can relate as well. You speak with an older person and they say, oh, a cup of coffee back in 1970 was only a quarter and now it's $2 or something, right? That's the result of inflation. When money is printed, things go up in price, not necessarily value, but up in price. And another example that I like to give is, anyone who knows me well knows I am I love trading cards. I used to growing up. That was my first entrepreneurial venture. And pulled this off of eBay. You can buy a Michael Jordan rookie card today for about $7,000. The reason it's so expensive is, well, he's arguably one of the greatest, if not the greatest basketball player of all time. But there's a rare quantity of these cards, right? There's only so many of them. What would happen if the card company Fleer decided to just print billions and billions and billions of Michael Jordan rookie cards? Well, now they would be worth a lot less simply because the quantity has increased. Now everybody's got one. So it's no longer rare. And that's exactly what happens to our money. Okay. So this is an important point when you're talking to anyone who's maybe a prospective private lender, because if they have money just sitting in the bank, the more money that the Fed prints, the less their current existing money is worth. So they got to be able to get their money working. So how do people get their money working? Well, the three most common are, number one, the stock market. Number two is real estate. And number three, I just kind of grouped together. It's all the banks and the bonds and, anything that's kind of derived off federal interest rates and life insurance policies and whatnot. That's like kind of CDs, bank CDs, money market accounts. That's all kind of grouped together with the banks there. But those are the three most common. And you're going to learn right now kind of why real estate is the safest and the best, really. Just pulled this off bankrate.com. So check that website out if you want to kind of stay in touch with the Fed and what's going on with interest rates. But yields on savings accounts and CDs, which tend to follow the Fed's actions, have been on a steady decline following the Fed's rate cuts. And as we are today, Jay Powell with the Fed has already come out and said they're not even thinking about raising interest rates. It would crush the economy if that happened, by the way. So the rates are extremely low right now. And in this presentation, we're going to encourage that you get out there and get some of that bank money. But sometimes the private money is what allows you to acquire the asset and get the property fixed up. Okay, and then you can actually take advantage of this bank money. But this is a good slide just to see that if somebody plans on saving their way to wealth and freedom, it's not going to happen from sticking your money into a bank account. That's the worst place. Now you got the stock market, and the stock market has completely had a V-shaped recovery, since the pandemic, since the big sell-off in March. But this is not based on fundamentals whatsoever. Think about it. So the big FANG stocks is what they say, these giant tech companies, Facebook, Apple, Amazon, Netflix, Google, they're all trading at record highs. Why? Is it because they're selling more advertising? Are they selling more MacBooks? Are there more subscribers to Netflix? No, I don't think so. It's just fundamentally inflated. And anyone, with a kind of common sense business mind who's been around a little bit can see that, there's just not good value here. It could change at the drop of a dime. The president could come out, or, we don't know how the election is going to turn out at the recording time of this video. So there's just so many things that could influence the person's money in the stock market. And the fundamentals are currently pretty much out the window in the stock market. Now, when it comes to real estate's going up. Okay, single family houses specifically is the driving engine of the real estate market right now. It's going to continue that way simply because interest rates are extremely low. They're going to be low for a long time. And the thing that keeps people out of real estate, why everybody's not jumping in, is it's not easy to just hop into real estate. It's much easier to just go buy a stock or buy an index fund or something like that. It is more risky with these stocks and whatnot. But the reason more people don't do real estate is they don't have access to deal flow. Like I'm sure many of you do have access to deal flow. If you don't, you want to continue to follow RJ and I, because we have more in-depth, extensive trainings that, we can teach you how to find the deals, raise all the money that you need and whatnot. But a lot of your day-to-day private lenders out there, they don't have access to deal flow, but they would very much like to have their money secured by real estate and growing within the real estate space. And that's what you're going to have the opportunity to bring them. So real estate is the king cobra. I've got a little, little picture of a snake there, but, real estate's held up. So since 1980, we've had 5 official recessions, but in all of them, except for the one in 2008, because granted, the one in 2008 was caused by these crazy mortgages. We were caught up in that. RJ and I have been doing real estate since back then. But in all of the other recessions, home prices have only declined 2.7% from the beginning of the recession to the end of the recession. So as you can see, it's just much safer and more stable. Quick summary of where we're at so far. So banks don't pay enough to keep up with inflation. So saving your money, sitting on cash right now is not the best thing to do. Stocks are inflated, volatile, and not fundamentally sound. Real estate is historically the best, but it's tough to get into unless you have access to deal flow. But you're going to be able to bring this deal flow as a real estate investor to these private lenders. And it's real estate's tough to get into unless you know how to find good deals or know a strong operator like you guys. We're going to make you guys strong operators who can help these private lenders invest their money. Quick disclaimer, me and RJ, we're not attorneys. We don't hold securities licenses. Raising capital from other people is serious business. Consult with your own legal counsel. Everything I share with you is based off my own and RJ's own experience for entertainment purposes only. We take no responsibility for any losses you may incur. We only take responsibility for your gains and successes. I'm just kidding, but got to get the little disclaimer out of the way there. And, you know, me and RJ have been at it for a while. So, you know, we've successfully, you know, raised over $20 million. That's just what's documented. I think you can add 10 million to that, but it's not documented. So I didn't use it, but, you know, we've successfully borrowed and paid back over $20 million. As of today, we have about $6 million of other people's money out there working hard on the street, secured against real estate. Primarily, we target single family flips, single family rentals, single family flips. We're going to talk a lot about the Burr strategy and kind of how to use private money for the Burr strategy. But, you know, me and RJ, we're not opposed to anything that you can leverage. You can, you know, produce a cash flow and it's going to be worth your time, right? That's really what it comes down to, is the juice worth the squeeze, you know? But real estate's a great vehicle to do all those things: leverage, cash flow. And if you set up the right systems and do this correctly, you can build a portfolio. It's not going to suck all your time away from you either. So a lot of what we do is the Burr strategy. If you're not familiar, that's just, we buy off market good deals with other people's money, rehab the property, rent the property. We refinance the property to get that bank money working now and get that private lender paid back. And then we repeat. And in my opinion, this is the greatest wealth building opportunity of 2020 and really for the next several years. You know, we're going to show you, and there's some examples here. We're going to help you, you know, learn how to pull out tax-free capital. Okay. And really just take advantage of all the benefits that real estate has to do. And we're in this artificially low interest rate environment. We really all want to be gobbling up as many assets that produce cash flow as we can with other people's money, is what we're going to show you how to do. So the Burr strategy, once again, I'll go ahead.
Let me go back to that slide, Dave, and let me just show the importance of why we're showing you guys how the importance of raising capital. And this presentation is to get private money, because if you use any other types of money, like, you know, bank money, to buy off market deals, it takes too long. Having private capital allows you to move faster and allows you to solve a problem with a lot of these sellers that we come across. They're in a time crunch. They need to sell yesterday, you know? So private money allows us to move a lot faster. And also it allows us to scale our business, you know? Because, you know, when a lot of the guys that are probably guys or gals in this presentation, watching this presentation, have probably run into flips where they have to wait for appraisals and having to wait for the bank to come in and do their inspections and all that stuff. You won't have that problem with private money, and it'll allow you to move a lot faster.
Exactly right. If you're waiting on the bank to fund your acquisitions, you know, you're going to have a lot of frustrated sellers on your hand, because what he said is exactly right. I mean, these sellers are selling at a discount for a reason, and typically there's a time crunch. And if you're waiting on a bank, you're probably going to end up losing a lot of deals to somebody who does have the private money raised, you know? So this is, you know, using the private money is going to allow you to move much faster, and you're going to get a lot more deals and a lot deeper discounts because you have the ability to perform. So basically what the Burr strategy, what we're going to be showing you how to do here, is you buy a distressed asset like a house using private money. You renovate the property, you get it rented out, and then you refinance the property. And at the time of the refinance, the private lender's paid back. And ideally, you can pull out a little tax-free cash when you do this. So we're going to show you some examples of this stuff as well. Most banks are only pay attention to these percentages. And since COVID, the banks have gotten more conservative. We just did a call with a banker the other day, and they're kind of lending at 70% now, okay? Most banks will refinance you out of, they'll give you a loan 70 to 75% of the value of the property, the after repair value, after it's fixed up. I'll just put a note in there, always try for 80%. Everything's negotiable, right? And that'll allow you to pull more cash out if you can get them up to 80%. But an example, the ARV, the value after repairs, is 100K. If the bank's giving you 75% loan to value, that's 75,000. your private money, if you bought it, if you were all in for 65, they get paid back, and that would leave you $10,000. That's tax-free money because it's not income, it's actually loaned money. But you can still, I mean, if you're paying back a high interest private money loan with a very low interest bank loan, you can even afford to pull out some cash tax-free for yourself and still lower that monthly payment so much that your cash flow increases as well. So that's kind of the way to do this thing. And we'll get a little bit more granular on that. But in this example, you know, the house is worth 100. Let's say you bought it for 50, rehab was 15. That creates your all in. So pay attention to the all in. We talk about that a lot in our trainings and videos. And it really is important because you want to make sure your all in, which is purchase and rehab, is going to be below what the bank is willing to give you. So if the bank's only willing to give you 70% of the value, you got to make sure what you buy it for and rehab it for is under that 70%, or else you'll likely be bringing cash to the table at the time of the refi. So the lower your all-in percentage, the more likelihood you have of pulling cash out, which is tax-free, when the bank does the refi. Here's what we talked about already. I'm going to buzz through this part fast here, and then we're going to get into the nuts and bolts. But I already kind of touched on there. Well, real quick, as a real estate operator, me and RJ talk on this a lot. Whenever we're analyzing a deal, there's 4 key metrics that the conversation always goes to. Number 1 is the purchase price. Sounds obvious, I know. Rehab amount, after repair value, and the rental amount. And you can look at any real estate deal and know those 4 metrics and kind of develop an exit strategy. That's exactly how RJ and I teach you guys how to do this stuff. Once you have the right metrics, you will easily be able to determine what the best use of your time and capital is going to be for the exit strategy. But these are the 4 biggies that we go back to on every single deal that we analyze. All in, I just kind of mentioned, this is going to be the purchase price plus the rehab is your all in. In our trainings, this is how we talk. So take note of that. Loan to value, again, it's probably pretty obvious to a lot of you guys, but let's pretend the home is worth 100,000 and the loan is 80,000. The loan is 80% of the value. So the loan to value would be 80%. Loan to cost. Now, this is a little bit tricky. And I remember when we first learned this, it took me a couple times. All loan to cost means is the lender's not going to give you 100% of your all in. They're going to make you put a little skin in the game. So oftentimes they're going to say, hey, we'll give you 90% loan to cost. All that means, everybody, is 90% of the money that you need for the purchase and the rehab. Oftentimes these institutional lenders will say, hey, we'll give you, 90% of the purchase price. So you got to put 10% down and 100% of the rehab. That's a very common program. And that's good. It is what it is. I'm just teaching you kind of what it is, but let's pretend the home is worth 100,000. And then the loan to purchase the home is 60K. The rehab estimate's 20,000. So you need 80, but if the lender's only willing to give you 90% of the loan to cost, so if you're all in for 80, they're only going to give you 90% of that. Just a quick example. So you're going to have to come up with a little skin in the game. And oftentimes these big institutional lenders, they're great because the rate's going to be a little bit lower. But remember, at some point you will run into some issues if you have to put money down every single time. That's why we're going to teach you, it's okay sometimes to pay more in interest if you're getting 100% financing, because it's just more scalable for your model. Because if you have to put down payments down on every single loan, eventually you're going to run out of money at some point. So when you're first getting started, expect the lender to want a little skin in the game. You got to pay to play. When me and RJ first started, we were paying 12% plus 3 points plus 50% of the profit. So it's like pretty much I have no sympathy for anyone who doesn't want to pay high interest, RJ.
And also too, you got to think of it like, if this is your first time going after private money, you have to be willing to give up whether it's equity, whether it is loan to cost, and maybe you have to set that up that way because you have to build credibility. They need to trust that you're not just going to run off with their money. They don't know you yet, right? They may have seen you maybe on Facebook, or they heard about you from their realtor friend. But once you start doing business with them, then they'll ease up, you'll build credibility. They'll see that you're making your payments on time, and then you can go for a different structure. But this is all relevant to when you're getting started. Don't say no to money because it's not the ideal situation. Because a lot of times you're going to come across good deals and then you're not going to have any money. So then there's no opportunity for you. So keep that in mind. But Dave, go ahead.
The better you get at this stuff, the lower the money cost is going to be. The cheaper the money gets, the better you get, right? So yeah, you got to pay to play. And you know what? Let's say you're only keeping 50% of profits on your first couple deals. Guess what? 50% of something is better than 0% of nothing, right? Next here, simple interest, guys. You know, for the sake of pretty much everything you do is going to be interest only. So it's real easy to calculate kind of what the payment is going to be. I'm going to show you guys how to do that. But simple interest, keep it simple. That's our motto. And you know, the way you find out what your payment's going to be at 9%, you know, let's say 72,000 at 9%, that is 6480. That's for the year, right? And then you would divide that by 12 to come up with a $540 monthly payment. The most common mistake that we just had this conversation with a different lender we were training, kind of showing this stuff to a couple of weeks ago, and it's the mind thinks like, okay, I'm loaning you $72,000. What's 9% of that? They punch in their calculator. Cool, 6480. So I loan you the 72,000. Let's pretend you buy a house, fix it up, and get it refinanced. It only takes you 60 days to do that. When you get paid back, the lender thinks, a new lender thinks they get their 72,000 back plus the 6480, regardless of how long it takes. No, what you're going to see is that is separated. And I'm going to teach you actually how to figure out what your day rate is. It's all done by a daily rate. But I can't tell you how many times a new lender says, oh, I thought I got the 9%, that's 6480, regardless of how long it takes. No, you don't get it. So you're going to get the day rate. That is the annual rate. Okay, so 6480, if it took a whole year, you would get 6480, but I'm going to teach you how to break this down and then educate your lenders. You're going to run into that one as well, I guarantee, when you start doing these presentations. Also, make sure you hang out to the end. We're going to be kind of teaching you exactly what to say to these lenders. We might even get into a little role play depending on how much time we have. Accrued interest, this is where you're not making a monthly payment. So it could still be 9%, whatever. But this is where you don't have a monthly payment, but the interest just keeps building up, and then it, gets paid when the house sells or when you are, refinancing or paying the lender back. Okay, so you're still paying interest, but it's all paid at the end, and this is ideal for short-term lending flips because now you're not bleeding your operating capital by making these monthly payments. Could you imagine if you always have to put a down payment with a loan to cost loan and you always have to, pay monthly payments on all your flips? Your operating capital could really get burned up pretty quickly. And ask us how we know. We learned this stuff the hard way.
Absolutely. At one point in time, we had over 20 rehabs going and we were strapped for cash and we had to sell something. So structuring it, how Dave said, accrued interest, is going to allow you to breathe and allow your company to have cash flow to operate for the next 90 days. So good point, Dave.
For the flips, especially, not so much for the ones that you're going to refi, because now you're a little, you're waiting on the bank at this point. When you're doing a refi, it's okay to pay the monthly payments because now your payoff is that fixed amount. It's not going up every day. You don't want it to be kind of a moving target when you're waiting on the bank, because if they take too long, now it's like the interest is accruing. So that's just something that we have found in our experience. But amortization is pretty common. This is after you get a bank loan, and that just means your interest is, principal and interest. It's not interest only. You're chipping away at the loan for any given amount of time. Like a 30-year mortgage, it's amortized or paid back over 30 years. So a portion of the payment goes towards interest and a portion of the payment goes towards principal. There's a note. So a note is simple, guys. It's a promissory note, just a piece of paper that spells out the terms of the lending deal between us, the borrower, and our private lender. Then there's a mortgage or deed of trust. If you're out west, I used to live in Arizona. They use deed of trust out there. I actually prefer deed of trust states. If you ask me, we're in Ohio, we have mortgages, but it's just the security instrument that gives your lender the lien against the property, right? So this is what is in place to protect the lender, and it uses the asset as the collateral. And if the terms of the note, promissory note, are not fulfilled, then the action would be the lender would get the collateral, which in our business is a house. Payoff. This is important to know, guys. So remember how I said a lot of times a new lender thinks, hey, I'm getting 9% of my money. It's not the full 9% if it only takes you a short amount of time. So let me explain. Let's pretend the loan is $72,000, 9% interest only loan. And you, the investor, you bought the house on 5/19/2019, sold the house on September 18th, 2019. So it only took you 122 days. Should you have to pay the full annual 9%, that's $6,480? You only had the money out there for 122 days. Then they got paid back. So you got to figure out what the day per diem per day is. So you take your annual amount, which in this example is $6,480, and you divide it by how many days in a year there are, 365, and it's going to give you $17.75 per day. And then you just times that, multiply that by the number of days that you had their money out working and before they got paid back. So what you would do then to determine the payoff is you figure out your day rate times it by the number of days, add that to the principal balance, because remember, it's interest only, these private money loans, and then they get back their full 72,000 plus the day rate interest added up, and they would get the 74,165.50. So debt versus equity, you're going to hear in the financial world people saying, oh, I'm raising debt or I'm raising equity. That used to confuse me when we used to go to these fancy meetings, me and RJ, and we're just learning this stuff. So basically, debt is just where you are borrowing money and the lender's going to get an interest rate on their money, and that's it. Equity is where the lender's paid back in the form of a piece of the profit or equity in the deal. So it's very common with bigger deals to have a hybrid of debt and equity. And I'm going to teach you a little trick here for a minute. But let's pretend the lender wants 12% on their money, but the borrower has to use this money to stabilize cash flow property and to get the rents up, and they want to keep their payments low. Let's say, man, I'm willing to pay you 12%, Mr. Lender, but man, that's going to put me in a major negative cash flow situation. Well, sometimes you do a hybrid deal where you're going to pay them 6% monthly, but then after the refinance goes down or the property is sold, then you will bring the rest of that 6%, to make it a full 12%. You would pay them almost like if it's an accrued note. It's a mixture of like a paying monthly and accrued. So you keep your payments a little bit lower, and you can, give them more money on the back end after the property sells or refinances to increase their yield to that desired 12% for that example. So equity investors, the advantage here is you don't have to make the monthly payment, or you can keep the payments lower. And when the deal's done, some sort of profit split is made to compensate the investor who gave you the money for the deal. Interest versus yield is an interesting thing. A lot of people don't get this, but this might come up for you at a dining room table, a cash flow game or something. You can impress your friends with this one. So interest is what you are paying out. So if you're borrowing money and you're paying an interest rate, that's what it is, interest. You're paying out monthly payments, that's interest. When you are receiving a return on your money, then you refer to it as yield. So you'll hear a lot of newbie lenders, they say, what interest am I going to get out of my money? A more seasoned money person is going to say, what is my yield going to be? Because that's what you're earning. Interest is what you pay. But that's just for a little vocabulary there. And leverage is another vocabulary thing you always hear if you're just getting started in real estate. Oh, you got to use leverage. All that term means, everybody, is, when you're using other people's money or using the bank's money, that is what using leverage means. And really, you have to use leverage if you're going to grow a portfolio at any reasonable amount of speed. I mean, you can't just save, just like you can't save your way to success and riches because the bank's not going to pay you a good yield, not interest, right? Yield. Also, you got to use leverage, and that's what that term means in the financial world. So draw schedule is another one. So let's pretend, hey, you borrowed $60K to buy the house and the rehab was 20. They might say, hey, I'm not giving you the full 20 up front. I will give it to you in draws after I see the work is being completed in the different phases. That's what a draw schedule is. And we're going to get in just kind of the types of loans, guys. Hard money loans, this is typically an asset-based and relatively short duration, 6 to 24 months. And it's used primarily by experienced rehabbers to buy a rundown property, fix it up and flip it, hopefully for a profit. And, you know, a lot of times you're going to have skin in the game with these types of things. They're going to have a very conservative LTV, remember loan to value. And most hard money lenders, they don't like to make loans to people who are newbies. So just like RJ mentioned, you got to sometimes build up the track record a little bit, and you got to expect to pay to play while you're just getting this thing underway. Construction loan is just exactly what it says there. It's, you know, borrowing money for the construction of a property. I did put a little note there at the bottom. I see a major opportunity here, flipping lots and or building houses. I've been doing a lot of research, and I mean, single family home starts are like through the roof. It's up over 7% since their peak pre-COVID. Single family is a very hot commodity right now as of October 26th, 2020. More on that Wednesday, if you're going to be tuning into the big debate. We won't get into that now, but you know, construction loan is just that, using money. Maybe you already own the land and you're borrowing the money. If you already have a first position mortgage or loan against a piece of property, and then you're taking on a construction loan, typically that would need to go into second position. So it's not as safe. Typically it's a higher interest rate. You got to pay a little riskier loan. Cross-collateralized loan, that's just a blanket mortgage. So let's pretend me and RJ own 5 houses, and you know, the lender wants to cross-collateralize this loan. So their money would not just be secured against one house, it would be secured against many houses. That's all it is. Hypothecate is another big scary word. Bring this one up at the dining room table as well. It's not that scary, everybody. This is just where you are, you know, borrowing money, and the collateral is not a hard asset like a piece of real estate. The collateral is a note. Easy peasy. That's all it is. It's a big fancy word that doesn't mean anything. Joint venture, this is just where maybe you bring the deal, somebody else brings the money, split the profits at the end. It's quick, easy, great way to get started. Again, remember, if you don't have the money, but you're good at finding deals, the money will find you. Just find people to joint venture with, and we're not opposed to looking at these kind of deals either. Seller financing, in my opinion, is number one, everybody. You can structure the best terms on money. Seller financing is private money in disguise. It's a quote from the great Pete Fortunato. And the truth is, not every seller needs 100% cash out of the sale of the property, you know, due to tax issues, desire for monthly income. They may actually be open to carrying back some paper, and they might actually be better off carrying back some paper. And what if, you know, they're open to just 2% money, 1% money, 0% money, right? It's all possible, but it really does have the potential to be a true win-win for you and them. So much possible here with seller financing. This is a whole day we could talk about seller financing. We love it though. 100% funding is really what you want. So this is ideal for us as real estate investors. This is the opposite of having skin in the game. If you can, once you've built up your track record, kind of get 100% financing where you get all your purchase money and all of your rehab money, and you don't have to wait for draws, and you get it all up front, it allows you to stay the most liquid and really the easiest to operate when you're not, you know, having to wait for draws and things like that, and then having to put skin in the game.
Let me touch on that real quick. You know, again, comes back to that, look, when you're starting out, you have to be okay with maybe paying a little bit more interest, but you're getting your purchase and your rehab money all funded. So be open to how the conversation is going to go with that potential private lender to structuring deals like this, and giving up a little bit of the interest rate, because you're not going to, you know, you're not going to just find your first lender isn't just going to pop out and be like, all right, I'm going to give you 6-7% money and I'm going to give you all my money, right? So you have to build that relationship. Go ahead.
Build your relationship and build that track record, you know. Transactional funding is typically when you're going to do like a double closing. You found a good deal and then you found a buyer, you close on it with a transactional type of loan. And we do these kind of loans all the time. And then you turn around and sell it the same day, like a back-to-back closing, double escrow. These are very common if you want to hide your assignment fee, if you want to hide what you're making from, you know, your buyer or the seller. Best thing you could do is a double closing. And if you don't have the money to do it, you're going to need a transactional loan, just for like a wham bam kind of thing, just to close on the house and then turn around and resell it. So now we get into the good stuff, everybody, how to raise money and where do you find the investors and the partners on how to do this thing. So first off, number one, people you know, friends and family. Number two, people who you know or have worked with or their friends, people you have reached, or number three, people you've reached out to from your marketing. And I'm talking about the first two. This is all me and RJ do here. The reason we're not getting into number three and teaching you how to market for private lenders, you're going to network your way to private lenders. You're not going to be running ads on the radio and guaranteeing people an interest rate, a yield is what I should say, right? You're not doing all this. So you don't need to do this stuff, okay? Reason being, because we're not registered with the SEC. And I'm guessing if you're listening to this, you're probably not registered with the SEC either. And this is the Securities and Exchange Commission, which monitors all of the, financial regulation, all the securities laws. So guys, we don't need to go all this crazy registering with the SEC. You don't, if you're doing this the right way. But if you were to market and run TV commercials and radio ads, you would need to be registered with the SEC. We're not talking about marketing for private lenders. And another question we get all the time is, once you get a little fancy, people ask, hey, do I need a PPM? What is a PPM? It's a private placement memorandum. And if you were mixing people's money together in the form of a fund, you create your own fund and you take, 100K from Susie, 50K from Jimmy, and 40K from Bobby, and you mixed it all together. And then you went and bought a property for, whatever that adds up to be. Now, yes, you do need a fund for that. You need a PPM, but the way we're doing it, there's one lender, one borrower, and they are the sole owner of this mortgage and promissory note. So when you are doing it this way that we're teaching you, you do not need a PPM, and you won't be advertising on any public media to attract investors. You don't need to do that, by the way. And we're going to teach you what to say and how to find these lenders. So bank money is the cheapest capital that you can get your hands on, and we all need to be going after that low interest, long-term debt for our real estate. Owning assets long-term that produce cash flow will make you rich. Bank money will allow you to do this. But remember, banks will only lend you money on a property that's already fixed up. And then you need an application, appraisal, this and that. And like RJ mentioned, you can't move quickly when you're in the acquisition phase. If you're relying on a bank, that's why we use the private money to buy the house, fix it up. And then we go with the refi. That's that, that fourth R, I think, with the Burr Strategy is that refi, but that comes after the acquisition, after the rehab, and after it's already rented, then the bank gets involved here. So you need money quickly and easily to make your offers to motivated sellers. That's your private money. And then you want to put the bank money in place after. So good hard money resources, Fund That Flip and Lima One and Wildcat, they're all great. But remember, there's still an application process, still an appraisal fee, skin in the game. And typically the money will come from somebody's cash just rotting away in a bank account. We already talked about why that's not a good idea with inflation and everything else. Or it'll come from retirement money. With the U.S. CARES Act, you can actually, and I want you to investigate this more on your own or take more of our in-depth trainings where we'll show you exactly how to do this stuff, but you could actually help people borrow against their 401k and use that money to lend to you for real estate deals. What we do a lot of is self-directed IRA money, and we help people get set up with a self-directed IRA, and we have our own self-directed IRAs. And it is the cleanest and easiest thing that I know of to get these loans done. And our private lenders love us for it. If you're interested in setting up a self-directed IRA, contact Mr. Derek Long with Quest Trust Company. He has helped us and many, many people set up our IRAs. We use Quest as well. And Derek's email is Derek, DERRECK.long, LONG, at questtrust.com. Tell them Dave and RJ from the Cream sent you. The two documents you need to pull this off, and we already kind of touched on this, but this is what an IRA custodian is going to ask you for. You got to have the promissory note. Remember, it lays out the terms of the deal, and you got to have a mortgage or deed of trust, which is the security instrument. They're going to inspect that to make sure it all looks good. And a few tips here. Know what your goals are. Know what you're looking for. Are you going after single family? What ARV range are you going after? And we can help you formulate these plans at some of our more advanced trainings. But, when you're talking to a prospective lender, if you don't even know kind of like what you're going after, the answer is going to be no, is what it's going to be. If you don't have, you got to be sharp, and we can help you develop these plans. Me and RJ used to joke around. Remember, RJ, when we used to say, it's like, man, you want to own a business, but you don't even have a checking account. Like it's the same thing goes when you're raising money, right? Like you got to
Right.
know what it is you're going after.
If you sound not confident in what you're talking about and you're confusing them, the answer is going to be no. They're not going to trust you, and they're going to be confused.
It's exactly right. With any sale, it doesn't matter if you're selling cell phones at Singular like RJ used to do, or selling, long distance at MCI like I used to do. If you're not confident in what you're selling, if you don't have your facts together, the answer will always be no. And then guys, just a safety net for you, pay attention to estimated rents on properties that you're targeting. And that's just because if you wind up with an accidental rental, you want to be able to know that you can get this thing performing. And a good source for rents, by the way, is Zillow. Quite honestly, Zillow's been very accurate. I encourage you to check that out when you are doing your due diligence. And remember, that's one of the four things that we always look at: the ARV, purchase price, rehab, and number 4 being the rents. If you're new, please just do us all a favor and avoid big rehabs. In fact, don't even consider a deal where the rehab estimate is more than the purchase price. That's the number one red flag when we're underwriting a deal. It's like, oh my goodness. Because one of the biggest moving parts and one of the biggest ways to lose money is through rehab and through the construction. Just avoid big rehabs altogether. Just keep it simple for yourself. Avoid making this complicated. Keep it simple. If your potential lenders, investors are confused, answer is going to be no. Because like RJ just said, you're not confident. If you don't know what you're doing, avoid raising money from money people. Heck, you come to me and RJ for a loan, we know what we're doing. The finance are going to be very favorable to us, and we will do JV deals by all means, especially when you're first getting going. Like we said, you got to pay to play. But after you get pretty good at this stuff, you're looking for corporate Jim or Dr. Susie, right? And they, have a great job and they have no intentions of leaving their job, but they got a little money. Maybe they want to get money working outside of the financial markets. Talk to your CPA. They know people with money. But again, the number one thing I can stress, guys, is just know what you're talking about, right? Know your program, know what you're going after, know why you're going after that particular asset class. And this is all stuff that we help people with all the time and help you formulate your plan. So you're going to be an assassin out there. You can get out there and snipe off all the private money that you can handle. There's a lot of networking meetings, Chamber of Commerce, BNI, and right here at the Cream, everybody, we're always talking private money. And here's just a quick little elevator spiel here for you. And this is something that, we just kind of typed up, and I encourage you to kind of formulate your own elevator spiel. But as an example, just say, I buy cash flowing houses and apartments that provide my investors with a solid return. And we're in a great market for this. Understand your market statistics, right? So let me know if you have any friends who want to learn more. And that's a good soft close. Ask if they have any friends interested. And if you kind of know your stuff well enough, if they start asking buying questions, like interest questions, chances are that person's going to want to lend to you guys. Okay. So establish your identity. Make it known that you are actively pursuing investing in real estate. Don't be shy about this stuff. You can do it. Have that confidence. If you're around me and RJ, we're not going to let you, doubt yourself, right? You have the best knowledge and education at your fingertips here with two guys who do this on the day-to-day. And, let everybody know that you're out there looking for off-market opportunities, and let everybody know that, hey, affordable housing, real estate is way more stable of an asset class than the volatile stock market. Start to follow this stuff. Follow me and RJ. I mean, we talk about it all the time. Do your homework, know your stuff. And you need to be able to tell these people exactly what you do with their money, because anyone is going to want to know the details, but also don't make it complicated. So a quick little, snippet here would be something along the lines of, hey, we invest in distressed residential real estate here in the Columbus metro area. We typically buy these properties at 30 to 50% discount. We either wholesale these properties to other investors, rehab the homes and sell them to a retail buyer, or rehab them, get them rented, and then refinance. These properties are typically off market, so we're able to get great deals and share the wealth with our private lenders. Just give them a general broad stroke here, and then you can start to educate these people on exactly how you do it and how their money's safe. That's the only thing everybody wants to know. So business systems are important, but investor relationships always is number one. So we all want to build the best systems, and that's what we help you with. Me and RJ are constantly improving our own systems and teaching you guys to do the same thing. We all want to build systems, operate more efficiently, and outsource tasks. Relationship building and management of your relationships should be your number one duty, and it just cannot be outsourced. It doesn't work that way. And you need to always be available to your investors. This sounds like common sense, but don't be a knucklehead. Always make sure your payments go out on time. There's no excuses. Many times, this is your investors' retirement money. You must be responsible. Pay your lenders before you pay yourself. Would you agree with that, RJ?
Yes, exactly. That's how we have it set up. And in the beginning, how we had it set up is everybody gets paid early in the month, and we do it through Chase Bill Pay. Now, you guys might bank at Fifth Third or PNC, whatever you got to do to set it up correctly. Up front when you onboard a new private lender is so key, so that you're promising that I'm going to pay you. You got a promissory note, all this, but then following through and making those payments on time, it's going to build your credibility. They're going to build the trust. They're going to want to lend more money to you, and then most important, they're going to tell their friends about how they had a really good experience with you. And that's a lot of how we're getting more private lenders now more than ever, is through referrals.
Absolutely. And we can actually teach you, and we do teach this at our more advanced stuff, but using wraparound mortgages, you can help your lender be like a bird dog out there for other lenders, and then they can actually get their money working and get their money involved and make money every single time they do a deal with the private lender they brought to the table. It's just an endless sea of capital out there, everybody. Quick sample deal, then we're going to put a bow on this thing. Purchase price, look at this little house here. It's one we bought. I like that American flag hanging in the garage there. Obviously, this sucker needs a little roof, but purchased this property for $100,000. Rehab was $20,000. Loan that we needed, our all-in was $120,000. Estimated rent, $1,200 per month. I like that. Whenever you can borrow money and the estimated rent is like at or above 1% of what you're borrowing, that's a good safe little play right there. A lot of times people do the 1% rule against the value. In this case, the value is 160, but the estimated rent's only $1,200. For it to be 1% of the value, it would have to be $1,600 per month. This one's not. But just focus on what you're borrowing, and let the ARV take care of itself. But first thing that we're looking at here with our 4 metrics, excuse me. Told you guys I'm a little under the weather today. Hang in there with me. But, in this particular example, the ARV is 160. We're borrowing 120. So we are, we're all in for 75% of the fair market value. And the loan is $120,000 at 10% plus 2 points with this particular sample deal. And it's interest only, AKA the simple interest that we went through. Monthly payment, remember, take your loan amount times 10%, then you divide it by 12. That's your monthly payment. And remember, if you wanted to find out your daily per diem, you take that annual rate, that annual amount of $12,000, and you would divide it by 365 and then, multiply that day rate by how many days you had that money out, right? Points, 1 point equals 1% of the loan amount. So 2 points equals $2,400 or 2%. So in this particular example, let's say it took us 75 days to rehab the house and get it rented and refi. The loan was 120 at 10%, 12,000 divided by our 365. It's $3,288 per day, 75 days. That's $2,466 plus your 2 points of 2% of the loan amount. You are going to basically pay them $120,000 back, their full balance principal loan amount, plus the interest per diem and the points. So they're going to get paid back $124,866. And if you kind of calculate that, punch that into a calculator, $4,866 yield, remember, because they received it, on a $120,000 investment in only 75 days, 2.5 months, that is a 19.2% annualized return. That's easy money. Not to mention, if you ended up selling the property, you borrowed 120, paid them back 125 basically, and you sold it for the 160, you're making a pretty good profit as well. There's plenty to go around, and you can afford paying these, high interest rates when you're able to get out there and get good deals. RJ, we're getting ready to wrap this up. What else comes to mind?
What comes to mind is, where are you going to get a return like this? I don't think you can get that in the stock market unless you're trading every other half hour or whatever. I mean, it's just the time on your investment with these deals. It's phenomenal. And so that's why a lot of people are looking at real estate right now as a tangible way to get their money working. So Dave, I think you hit on a lot of good points here, and I'm excited to see kind of what comes about with who's gonna take this presentation and actually put it to use, and we're happy to help you guys. So bring us home.
Let's go. So anyone, 19.2% in this particular deal. Watch this video over and over and over and over again. Internalize this stuff. You're going to get good at it. This isn't meant to be a one-time watch. Watch it again and again, and you're going to start to figure this stuff out. And the better you get, the easier it's going to be to raise all the money that you need for your real estate deals. And I just wanted to give a big thank you to everybody who took the time to watch this, and like RJ just said, we're in your corner. Please continue to give us and each other grace. We are not perfect, and we are not meant to be perfect, everybody. Okay, that's the ego making you think you got to be perfect. Nothing's perfect. It's perfectly imperfect. Like any family, like any community, we're all better together, not competing and fighting with one another. Your life does matter. You do have a voice. We are in this together. Let's continue to get rich, strengthen our community. RJ and I are very grateful for all of you. We look forward to continued success. And with that, I hope everybody has a wonderful day.